Hello, guys, and welcome to another Revise in 5 with me, Mr. Schmalish. This is another really special edition. This was created by a student for students for obviously business revision. Now, this is for OCR specifically, but most business courses will do business ownership, which is what this little revision session is on. So I've not really seen what has been created, but I'm sure it's really, really good. So this is based on the free science lessons, I believe. Shout out to that person. Please don't sue me for copyright. I didn't make this. I'm also supposed to say keep it lemon mush, and I'm pointing to my Stone Island jacket badge. Okay. So as I said, this lesson is revision session. Sorry, is on business ownership. So by the end of this video, you should be able to describe the different types of business ownership, explain limited liability, which is a big term in business, and identify the advantages and disadvantages of the four main types of business ownership that you'd be looking at in OCR business studies. Right. So the first type of ownership is a sole trader. So this is where a business is owned by one person. Okay, they can employ many people, but there's only one owner, and it's also the most common type of business ownership in the UK. Most businesses start up as a sole trader because it's quite easy to set up, and most businesses lend themselves to being suitable for sole traders, such as driving instructors, shops, personal trainers. Pretty much any profession could be a sole trader. The advantages are, as mentioned earlier, that it's very easy to set up, okay, compared to partnerships, private limited and public limited companies. Very little capital required to start. You don't need a lot of money. You can start a business for like 50 to £100 as long as you've got the stock to sell. You're away, and you get complete control. Not only do you keep 100% of the profit, you are your own boss. You make all the decisions. Okay, and privacy. What this means here is because you're a sole trader or partnership applies to actually, you don't need to publish your accounts publicly. Both public limited and private limited companies do. And obviously, competitors can have a look at your accounts, see how well you're doing, have a nose around. And it's also very expensive and time consuming to do. But as a sole trader, you do not need to do those for the public. You just need to keep it for yourself, obviously. There are all the advantages. Some disadvantages, the biggest one is unlimited liability. Now, this is where the sole trader and the business have no separate legal identity. So any debt the business occurs, the individual also occurs as well. So if they need to collect debts, they'll take obviously the business assets first. And if that isn't enough to cover the debt, and they're going to take your personal assets, such as your home, your car, any personal assets you own, any buildings, anything like that. Okay. Another disadvantage is there's no continuity in sole traders. What I mean by that is if you die, the business ceases to exist. Okay. Or a slightly less morbid version, that is if you're sick, okay, the business tends to close down. You might have employees to help you, actually, but if you're sick long term, the business is going to suffer. You have to work really long hours, which puts a strain on your mental health and relationships. Okay, and that can obviously have a really bad effect on your physical health. Right. The next type of ownership we're going to look at is a partnership, where this is owned by at least two people. It's between 2 to 20 people, okay, 20 partners. It's very common in certain types of businesses, as um, as put here, as an accountant, dentists, lawyers also do this. A lot of builders do this. You might see a lot of partnerships in construction and things like that. Okay, so the advantages, again, like a sole trader, partnerships are fairly easy to start up. There's not a lot of red tape, but you get more capital. There's two people who can provide the startup costs, which means that you can probably start a business quicker, or you can buy more expensive equipment. So looking at the businesses that are suitable for partnerships, such as dentists, accountants, lawyers, there's a lot of startup costs involved in getting the equipment, furniture, the write licenses, so on and so forth. So having more than one person provide the starting cost is going to really benefit the business, and the workload is shared. Okay, so it's not down to one person making all the major decisions or doing all the major work. It's actually shared between two or more people. So the person is less stressed, has more time to themselves maybe, and is really good for their mental health. Some disadvantages though include that because you're not the only person in charge, you have to share your profits. So any profits made is shared according to the deed of partnership that has been written up before the business has started. If there's no deed of partnership, then it is a 50-50 split, regardless of the amount each partner brings in or the amount of work each partner does. Okay, like a sole trader, it does have unlimited liability, and there's a slower decision making process because you've got to consult your partner. You can't just make all the decisions and quickly implement it. You've got to talk them through, and piggying back on that is that if you disagree on decisions, that's going to cause friction and that's going to harm the business. So in OCR business, the partnership is going to be a normal partnership. You do get a couple of types of different partnerships. You do actually get a limited liability partnership, but in the exam that they're going to mean an unlimited liability partnership. Okay. You also get something called a sleeping partner. Now these provide the capital, but they do not take part in running the business. So all the decision making is down to you, but they do have limited liability. They're not liable for any of the debts either. Okay. I don't think this will pop up in the exam, but it's worth what a sleeping partner is. So the next type of ownership is a private limited company. Now, these have owners that are known as shareholders. Okay, so they own a part of the business. Okay, private limited companies have limited liability. That's the big advantage. So not covered in here, but private limited companies will have LTD after their name. Okay, so they have limited liability. So that means they have a separate legal identity to their business. So if they incur debts, then the business assets can only be taken, not personal assets. So the house, their home, their cars, that's all safe. There's continuity in the business. If one of the shareholders dies, the business will carry on. Okay. Some of the biggest limited companies in the world are things like JCB, Virgin. Okay, so Virgin Atlantic, sorry. So they do have continuity if the original founder owner has stepped down or died. And the big thing, other than limited liability, is they have control over share sales. So that means they can't get taken over hostily. They control who buys shares. They can raise capital money by selling shares. Okay, so that also provides another source of finance for them. However, some disadvantages are that you have to pay dividends. When I say you have to, it's not a legal thing, but as a shareholder, if the business is making money, you're going to expect dividends. If you're not going to get dividends, you're probably going to start thinking you might want to sell these shares because this company is not giving you what you want. Okay, there's a bit more administration involved. So setting up a limited company is a lot harder than a sole trader and a partnership. Not as hard as a public limited company though. And financial information is public. Although it's called a private limited company, they do still have to publish their accounts online to the public. So anyone can access their accounts, see how well they're doing, might copy some strategies, so on and so forth. And that takes time, and you need to hire specialist accountants to do that. So again, it's an increasing cost. Okay, and not really mentioned here, but the good thing, as we said, is that shares are controlled. You control who buys them. However, that might be a bad thing. That might mean if you want to raise a lot of capital quickly, that might not transpire because people might turn down the ability to buy shares and so on and so forth compared to public, which is what we're going to talk about next. So the final business type is public limited company. We have a PLC after the name. So this is a business where they can sell shares to the general public, and you can buy shares on the stock exchange. There's many stock exchanges. There's the London Stock Exchange, New York Stock Exchange. It depends what stock exchange that business is on, but anyone essentially can buy shares in any business. And now these are your big companies like Amazon, Barclays, even football clubs such as Manchester United. These are big PLCs. Right. So advantages are you can raise capital a lot more easily and quickly because you can sell shares to the public. So anyone in the world can buy a share, which means if you want to buy equipment or want to expand, you can raise that capital at a much quicker pace than a private limited company can. Borrowing money is also easier because you tend to have a higher profile. Banks will tend to lend to you much easier because of that high profile. And you've got limited liability for shareholders again. Okay, so if the business collapses and goes into debt, the shareholders aren't personally liable for that. Some disadvantages, though, the big one here, the difference from this to a private limited company is there's a big risk of a takeover because anyone can buy shares in your business. That means the original owners could lose control of the business if more shares are bought out. Okay, there's a massive cost of setting up a public limited company. It costs £50,000 just to set up a public limited company, just to get your shares floated. Okay, which is a massive expense which not a lot of businesses can afford to do. Another disadvantage, not mentioned here, but obviously you've got to publish your accounts publicly. Again, leadership into scrutiny takes time and money, and size is sometimes a disadvantage. Big public limited companies make it hard to control every aspect of the business. Okay, so decision making is a lot slower. You've got lots of shareholders to negotiate with. A lot of PLCs are global companies as well. Okay, so that there might be language barriers and so on and so forth. Okay, but that's the end of this little presentation. I know it's gone over 5 minutes, but business ownership is a big area. I want to say a big shout out to the Mark Scheme himself, Noah Smith. This is a fantastic revision resource, and it was a pleasure narrating over it. And the last thing I guess I've got to say is safe work. G, I'm out.